Time now for business, and for that I'm joined in the studio by Charles Pellegrin. Hello, Charles.
Hi, Annette.
And today we're focusing on the direction of global oil prices and a new report out by the World Bank giving us a far clearer picture.
That's right, Annette. We've talked about it a lot over the past few days and weeks and months, especially this Monday when global benchmark prices for oil fell over 6% after Israel's airstrikes in Iran were limited to military targets and didn't hit any oil infrastructure, thereby easing any concerns there could be over global oil supply. This downward pressure on oil prices will continue next year, according to the World Bank's Commodity Markets Outlook, a new report out. This even contributing to commodity prices as a whole hitting a 5-year low. So next year, oil supply is expected to exceed demand by as much as 1.2 million barrels per day on average, a situation that has only happened twice before. You can see that figure there during the pandemic in 2020 and in 1998. So to help us better understand this, let's speak with Ayhan Kose. He's the Deputy Chief Economist at the World Bank. He's joining us live from Washington. Ayhan Kose, thank you so much for being with us on France 24. One of the major reasons behind the fact that global oil prices are set to continue to fall next year lies in China. So what's happening there to demand over there?
China accounts for 15 to 16% of global oil demand. And when we think about the good old days, China used to deliver growth 8%, 10%. That's not the case anymore. China industrial production is growing around 5%. And when you look at the take-up of EVs, electrical vehicles, hybrid vehicles, it's just quite steep. And you look at, the trucks fueled by natural gas instead of oil. So in the case of China, the days of China basically contributing a significant increase in oil demand appear to be behind us. With that, of course, the global oil demand also weakens.
So we're talking about downward pressure here, but there's also some upward pressure, and one factor, volatility, has been the escalation of violence in the Middle East. So could the downward trajectory in prices actually be reversed were Iran's oil infrastructure to be hit directly, for instance?
That's a possibility, but it's not in our baseline. How that could happen if there is, escalation of the conflict, and let's say oil supply declines by about 2 million barrels per day. That could translate into an increase in prices next year about 15% relative to our baseline. So this year, we think oil price is going to average for the entire year Brent price $80. Next year, $73. So the important point is that even with that increase from 73 to, let's say, $94, we think that will be short-lived because of ample supply out there. There is more supply than demand, but more importantly, there is ample spare capacity. OPEC plus producers, the big producers, Saudi Arabia, UAE, can bring to the market and compensate the increase in prices.
So oil is just one commodity among many. The report also forecasts that food prices are set to fall 9% this year and 5% next year, if I'm correct. What does this reduction in commodity prices as a whole mean for governments and especially for developing economies?
When you think about developing economies, obviously some of them are major consumers of energy. They are exporting energy, they are importing energy and importing oil. For them, the oil prices, energy prices coming down is great news if they are an importer, primarily because that means they can control inflation, they can control inflation expectations. The second important point is that this gives them an opportunity to eliminate very costly fossil fuel subsidies. We still have this significant amount of subsidies to basically given to all types of consumers, and that creates significant pressure on their fiscal balances. And the third important basic opportunity it presents, given the kind of deficits they have on their trade accounts, on their current accounts, they can basically reduce those deficits and reduce their vulnerabilities. So all in all, for importers, the decline in commodity prices, good news.
One final question about that report. One commodity that's seeing its prices actually increase here is gold, the sort of trademark safe haven asset. What does that tell us about the global economy, that gold is doing so well?
There are a number of reasons why we have seen this significant increase in gold prices. Gold prices are about 80% higher than what they used to be prior to the pandemic. Now, that's driven by, of course, elevated geopolitical tensions, very significant increase in policy uncertainty. When you think about, for example, trade policy, we have all types of restrictions around the world put in place that brings a lot of anxiety for exporters as well as, of course, importers. And you see central banks are buying gold, accumulating gold instead of some other types of assets they used to buy. When you put all of these together, of course, there is significant demand for gold. Going forward, we think that demand is going to be stable in our baseline, and gold prices are going to basically be flat.
Ayhan Kose, you're the Deputy Chief Economist at the World Bank Group. Thank you so much for sharing your insights on that new report released this Tuesday by the World Bank. And thanks for being on Press 24.